Laura Suter, Director of Personal Finance at AJ Bell, and today I am joined by Ryan Hughes, who is Investments Director at AJ Bell, and we are going to discuss the performance of the AJ Bell Funds and the Managed Portfolio Service over the last quarter of last year, but also 2023 as a whole. Hi Ryan, thanks for joining us.
Hi there.
So can you talk us through what happened towards the end of last year, how markets performed and what we saw in markets?
Yeah, it was a really strong finish to 2023 after what had been quite a challenging year. Most of the year, markets were broadly flat, but what we saw as we entered probably about mid-November time was a real pivot point there where markets changed their focus from interest rates being high and inflation being high to, okay, where do we go next in the cycle? And the narrative shifted onto, actually, we're quite a way through this economic cycle, and we're now likely to start seeing interest rate cuts during 2024 and inflation continue that trend of falling. So markets and asset classes responded very well to that, with a strong performance in the bond market, a strong recovery in the bond market, both in government bonds, corporate bonds, and actually high yield. And then in the equity market, we saw some exceptional performance from European equities, and also US equities, where the Magnificent Seven, those tech stocks, continued their strong run and finished the year very well to actually have a 2023 calendar year performance that was very strong. US markets were up around 20% for UK investors over the calendar year.
So clearly fixed interest assets have had a torrid couple of years, but it looked like they were starting to turn the corner towards the end of last year. Do you agree? Is that a turning point for those assets?
I think it is. You're right in saying that they really have had a torrid 18 months to 2 years, and that's hurt a lot of investors' portfolios, particularly at the lower risk end, where we see lower risk investors obviously having a high level of exposure to bonds and fixed interest, and in theory over the long run they're lower volatility assets that don't exhibit falls like we've seen over the last 18 months. Now that was amid a backdrop of rapidly rising interest rates and a very challenging economic environment as well. We had inflation climbing incredibly quickly, going through 10% in the UK. It's a very different picture today, and with the market focused on falling interest rates in major developed markets around the world, that is providing a much more supportive backdrop for fixed interest investments. So you've seen the markets respond to that. You've seen strong performance from UK government gilts over the last quarter, and actually end the year into decent positive territory as we look forward into 2024, with markets and investors thinking that rates should fall back, maybe not in the first half of the year, but certainly into the second half of the year as this weaker economic data comes through, and the central banks need to provide some more, not stimulus, I think, because it probably makes it sound too dramatic, but support for the economy through lower interest rates, and that should provide positive support for fixed interest, both on an income level. Obviously, income's a very important component part, but actually where it gets really interesting is the capital level. We should start seeing some capital growth from fixed interest investments, certainly as we get through the second half of the year.
So let's turn to the portfolio specifically, so the AJ Bell Funds and the Managed Portfolio Service. How did all of those things going on in markets impact the funds, and what was their performance like across the year?
Yeah, so across the range really, it finished the year very strongly as we saw that uptick in both equities and fixed interest. The funds and the MPS, all the different strategies we have, managed to capture that rally pretty well. So they finished the year strongly, and if we think about where they got to as overall over the whole year of 2023, then the returns across the range were broadly in line with our expectations. So total returns for the year of between roughly 5 and 8 to 9%, which was where we started the year, was our expectations for the year ahead. So pleasing that despite all of the volatility that we've seen and all of the challenges that we've seen, that all of the strategies have come out broadly where we thought they would, and certainly how we've communicated that to advisors at the start of 2023 and throughout. So yeah, I think on the whole, we're reasonably pleased with the end result, but certainly acknowledge that perhaps the journey to get there through 2023 was a little bit bumpy, and was certainly helpful that fourth quarter pivot in expectations really drove the kind of assets that we were invested in higher.
And so with that in mind and with the kind of shifting global economy for the year ahead, have you made any changes to the portfolios, to the asset classes to reflect that?
Yes, so January is the month where we update the portfolios for our thinking for the 12 months ahead, and so we've just made some changes to the portfolios, and they've been focused on a few key areas, mainly around the fixed interest side of things, given we've just been talking about interest rates falling and inflation falling and the positive backdrop that creates. So we have done a couple of things. Firstly, at the lower risk end, there's been a small increase in cash exposure. And everyone watching will know the returns that you can get on cash right now, and we're able to take advantage of that and have a small increase in the exposure there. But where we've perhaps done a little bit more work is increasing exposure to UK gilts and UK investment grade corporate bonds. And there we think the outlook is actually a little bit brighter. So what we would expect to see is that with a falling interest rate environment, that we can benefit from both the income and the capital side there, which should, I would hope, enable the fixed interest part of the portfolio to deliver returns in excess of what we can get on cash today. I'd also expect cash rates returns to fall through the year as those interest rate expectations change. So a small increase in cash, an increase in exposure to UK government bonds and UK investment grade bonds. Another thing we've done in fixed interest is reduce our exposure to high yield. So in 2023, that was a really strongly performing part of the portfolio. They did very, very well. However, as we go into 2024, we see a slowing global economy, we see an increase in default rates, and therefore the risk around high yield has increased. And therefore we think it's prudent to take some of that risk out of the portfolios. Now, some of that money has been put to work in UK investment grade bonds, as I just mentioned. So if we follow on from that into the equity side of the portfolio, then we have reduced a little bit some exposure to US equities, which have performed incredibly strongly over the last couple of years. And we've redeployed that capital towards European equities and Japanese equities, where we think the return prospects are appealing, but also the risk return characteristics look appealing, given they're not on anywhere near as high a valuation multiple as the US. The final bit of the portfolio is in the alternatives area, where we've taken a tiny bit of capital out of UK property exposure that we have, and that's simply because the risk return characteristics aren't quite as appealing as they were a year ago. So it maybe sounds like quite a lot of change, but it's small changes really to make sure the portfolios are well positioned, and there's a lot of information available on the website that can show exactly what's happened in each portfolio.
Excellent. Thanks a lot for catching up with us today. We look forward to speaking more throughout 2024.
Thank you.